Okay, hey everyone. Why don't you all come in? We're going to get started. So, for those who don't know me, my name is Madhav Rajan. I'm the Dean. I'm the George Schultz Professor of Accounting at Chicago Booth. Uh, we have an incredible number of attendees here for our first Distinguished Speaker Series event of 2025, and we also have a live stream going on in a separate room for one of our most popular alums. Every time Howard comes, it's a huge event. Howard is co-chair of Oaktree Capital Management, and is a perfect person for us to kick off our DSS with. So this, as you know, is an event where we bring in high-profile leaders from business, from the government, from the community to share their insights and experience. I think the last person we had was Mark Hoplamazian a few weeks ago, the CEO of Hyatt, one of our alums. But we've had, Byron Trott, Tom Ricketts, Jenny Scanlon, Matt Maloney, a whole bunch of people. Uh, Howard is one of our most distinguished alums. He's co-chair of Oaktree, and he founded Oaktree in 1995 and has been very much at the forefront of ensuring that the firm adheres to its core investment philosophies. And something Howard is very proud of is his communication. He communicates with clients concerning product strategies, what's happening in the broader market, and takes all the big picture decisions about investments and direction. Before that, Howard was at the TCW Group, leading investments in distressed debt, high yield bonds, convertibles, and prior to that with Citicorp for 16 years. So we're just thrilled to have Howard to come back here and share advice. So please join me first in welcoming Howard Marks. Thank you, Howard. So we have a ton of questions. I have some, and then we have a whole bunch that came in advance, and then I'll also open it up to audience Q&A a few minutes in. So Howard, maybe just start with what led you to co-found Oaktree, and what was your vision for the firm when you were starting out?
Well, I and the other other four founders reported to me at TCW. We worked together on average 9 years. We got along well. We respected each other. I think it's very important that partners should have shared values. If you're totally disparate kinds of people, it's unlikely to work. But also different and complementary skills, and we did. And so there were a variety of reasons. The guy who ran TCW was kind of capricious and liked to boss people around, and he would kind of get you up on the knife edge of compensation, and so he assumed you couldn't afford to quit. So he was pretty capricious, as I say. And then also, when I started in this business, I was managing high yield and converts, and I got 0.5% a year fee. Then we started in distressed debt in '88. Now we're getting 2% fee and 20% of the profits. And the question is, who gets the 20% of the profits? So they decided they deserved half. We thought they didn't deserve any because they didn't produce the success. So that was another issue. So that was the main issue, and we just thought we had enough going for us that we could go out on our own. So we were managing $7 billion when we worked at TCW, and we never had a budget, a profit plan. I always say that in Silicon Valley they do things on the back of a napkin. We didn't have a napkin. We never talked about how much money we could make, and we never asked whether we thought we could ever get back to $7 billion. But we just thought that we liked working together. We had done a good job for the clients. If we continued to do a good job for the clients, we'd probably have a successful business. That's it.
And what were the areas that you wanted to focus in when you started?
Oh, the same what we had been doing. Right? When we were at TCW, we managed money in, I think we had 7 strategies. High yield bonds, U.S. convertibles, international convertibles, busted convertibles, distressed debt for control, distressed mortgages. 7 strategies.
And has that changed over the years?
Well, we've added probably 10 more.
Okay.
And we have a somewhat broad product line, but mostly concentrated in credit.
Okay. And so over the years, are there some pivotal moments that you can remember that sort of shaped the future that Oaktree has had since that time?
Well, I'll tell you my greatest story. So I was in Chicago. I was in class of '69. And when I got through, I really didn't know what I wanted to do. You hear about all these people who, invested their bar mitzvah money. That was not me. So, I applied for 6 different jobs. We didn't do large numbers of jobs because there were no computers. Everything was done manually. So I applied for 6 jobs that were all different. And I was semi-indifferent between them. One was a little more glamorous and prestigious than the other. So I figured, I would take that. By the way, I was 22, It was not like now when you have to be 29 or something. So I was just some young, immature boy. But I figured I'll take that one. So that's the one I didn't get. And I got the other 5. And I had a good summer at Citibank Investment Research Department. So that's where I went. That started the whole thing. So 30 years later, Eric Gleacher endowed this building. And so I wrote him a letter. I don't know if you know what that means. In the days of letters. And I think it was about 1990. And I said, I don't know if you remember me, but I applied for a job and you were the recruiter and I didn't get the job, but I really applaud you for what you've done for the school by creating the Gleacher Center. And I get a letter back. Of course, it takes 3 weeks. You got to send a letter and then you get a letter back. And the letter back says, I remember you, and if you ever want to know why you didn't get that job, give me a call. So now I don't wait for a letter. Now I grab the phone, I pick up the phone, I call him up, I say, Eric, okay, why didn't I get the job? He says, simple, we hired the wrong guy. I said, well, you're very sweet to say that. He says, no, I don't mean it like that. All the recruiters had decided to hire me. And the partner in charge came in, maybe hungover, and gave the job to the wrong person. He gave the job to my roommate. It's a true story. And if it wasn't for that little bit of bad luck, I could have spent 40 years at Lehman Brothers and had nothing to show for it. So just think about that. When there's a saying that man plans and God laughs. That's what they're talking about. So that's how I ended up at Citi rather than Lehman, which is now out of business. So that was important. And then I went to the bank. The bank invested in what we called the Nifty 50, the 50 best stocks in America. I was, by the middle 70s, director of research. And if you own those stocks, you lost about 95% of your money. Best companies in America. So I was associated with that failure. But fortunately, in those days, American companies pretty much gave lifetime employment. So I didn't get fired. And instead, the boss said, I'd like you to move to the bond department. So I moved to the bond department. That's where I started managing convertibles. And then 3 months later, I get a call from the head of the bond department, August 78. The guy says, there's some guy named Milken or something out in California, and he deals in something called high yield bonds. Do you think you could figure out what that means? I said, I'll try. And that meant that I started Citibank's high yield bond activities in 78 at the very beginning of that activity. And if you read Malcolm Gladwell's Outliers, you know it's really all about being at the head of the line. And in that regard, I was. So we have more experience in high yield bonds, I think, than anybody else. And then I met my colleagues. I switched from Citi to TCW in 85, met my colleagues, and of course, we left in 95. And then the other thing that was really important is that, so from when I started, 69, until, let's say, 99, investing mostly consisted of stocks and bonds, maybe a little real estate. And then there were these fringe activities called hedge funds, venture capital, and private equity. They grew up mostly in the 70s and 80s. But it was tiny. It was cottage industry. But then we had the tech bubble of 97, 98, 99 into 2000, burst in 2000. Those stocks didn't go down 95%, they went down 99%. And everybody lost interest in stocks. The Fed cut rates to support the economy and the markets. Everybody lost interest in bonds. So if you're not going to do stocks and bonds, what are you going to do? Alternative investing. And that's when people concluded they needed the other stuff. And because people turned away from stocks and bonds and turned toward other things, that's why instead of the $7 billion we had at TCW in 95, we have $200 billion today. So those were the important milestones. And as you can tell, most of it was just luck. I mean it.
So you have a well-known sort of propensity for being sort of contrarian, if you will. Could you just give some couple of examples about that, Howard? How has that helped Oaktree over the years?
Well, so-called human nature, emotion, tends to conspire to make us do the wrong thing at the wrong time. When things are going well and the economy is rising and profits are reporting rising earnings and stocks are rising, people get more and more excited and they buy more and more and more at higher and higher prices. Then things peter out. The economy is not so great. The company news isn't so good. The prices are collapsing. Then they get depressed and they sell. Well, my mother told me, buy low, sell high. Human emotion tends to get you to buy high, sell low. So that's the essence of being countercyclical or contrarian.
Mm-hmm.
And most people have so many flaws. Too emotional, too greedy. They feel terrible if somebody's making money they're not making. So they rush into the market and they throw gasoline on the fire.
Mm-hmm.
And if you could just, well, first of all, you must abstain from that process. If you're part of that process, you'll perform as terribly as they do. But even better than abstaining is to sometimes do the opposite. Mm-hmm. And that's called contrarianism. Mm-hmm. Now, there's a book, I wrote this book called The Most Important Thing. And the second edition was called The Most Important Thing Illuminated. And I and some other investors, some friends also, inserted commentary in the book. It works well in Kindle. You see a black dot, you hit the black dot, and you get a comment on what you just read. And my friend Joe Greenblatt, who was one of the great equity investors of all times, inserted in the section on contrarianism that just because 5 other people won't stand in the path of an oncoming freight train doesn't mean you should. So blindly just doing the opposite of what everybody else does is not a good tactic. But observing the behavior of others, figuring out what's wrong with it, and maybe doing the opposite is warranted at certain points.
And now you've written a lot about market cycles, right? Like understanding the cycle. So how do you determine when it's time that you're sort of approaching the end of one and maybe the change of other? How do you change your strategy?
Well, so my second book was called Mastering the Market Cycle. And it's kind of a cheesy title, but the publisher wanted that because they thought they'd sell a lot of books. So I was talking to my son, during the process, and he's a professional investor also. He's a venture capitalist. And I said to him, Andrew, I think that my market calls have been essentially correct. So he says to me, yeah, Dad, that's because you did it 5 times in 50 years. And it's a very, very pregnant statement. 5 times, now I've been doing this 56 years. 5 times I found occasions when the market was insanely high or insanely low. And when it is, the logic, the analysis is compelling, and the probability of being correct is high. And I was right those times. And I wrote a memo called taking the temperature of the market. And that's what I believe this process is for me. I call it taking the temperature. And I do it based mostly on behavioral observations. Mm-hmm. But what if I had tried to do it 50 times or 500 times or 5,000 times? You know, I've probably been working about 19,000 days at this point. What if I'd done 5,000 market calls? My correctness would probably be at 50-50. I'd probably be as good as a coin. So what I look for is extreme error, excesses. And I happen to find it 5 times. So a great example is that in 07-08, we had the kickoff of the global financial crisis. And we lost, I guess it was all in 08. We lost Bear Stearns, Merrill Lynch, Wachovia Bank, Washington Mutual, AIG. And then on September the 15th of 08, Lehman Brothers goes bankrupt. And it felt like, you probably have never seen a movie called The China Syndrome. But The China Syndrome was an old movie starring Jane Fonda, and it's about a nuclear reactor that gets out of control, and it looks like it's gonna like do whatever they do. But whatever they do, it's gonna go through the world and come out in China. And that's why it's called the China Syndrome. It's gonna blow up the world. And that's what it's about. But it really felt like the world financial system was melting down. There were all these derivative contracts, and the banks, they had permitted the banks to become levered 32 times. So that means for every $100 of business they were doing, that $3 of capital. Now, if your assets go down 4%, you have no capital. And that's pretty easy in a catastrophe. And that's why these large institutions were disappearing as independent entities. And so Lehman Brothers goes. We all knew that Morgan Stanley was next, and Goldman Sachs was after that. And it seemed unstoppable because the leverage was high, the cataclysm was vast, and they were all interconnected. So, Lehman Brothers had bought protection from Morgan Stanley. Morgan Stanley borrowed its book by buying protection from Merrill Lynch, which bought protection from Bear Stearns. When Bear Stearns goes out of business, then the debts they owe to Merrill Lynch, they're not going to get. That means Merrill Lynch can't give Goldman Sachs the protection they promised them, and so forth. The whole thing really, you could think it was going to melt down. And of course, it was unprecedented. So there was no evidence on the basis of which to say, no, that's not going to happen. So Friday, September 15th, after the close of business, Lehman Brothers goes bankrupt. Monday morning, September 18th, I walk in the office. I got to decide what to do. And as Madhav said, I contribute to the big picture decisions as to tactics, not buy this or sell that or something like that. I haven't done that in a long time. But what do? You walk in. I've described exactly what you now know, everything that anybody knew that morning. So what do? Well, obviously, what you do is you analyze the future, right? Right? No, you don't analyze the future. There's no such thing as analyzing the future. You can't analyze something that doesn't exist. So you have to kind of reason it out. And I've been writing these memos to clients for 35 years. I started in October of 90. So the interesting thing, if you have any interest, is I can tell you what I thought at that time, but you can go back and read what I thought at that time, so I can't lie to you. And so I put out a memo. I think it probably came out on the 19th or 20th of September, and I think the title was either Now What or What Now? Can't remember. But what I said in there was, is the world going to end? That was the question. People were acting as if it would end. Things were valued as if it was going to end. Will it end? What I said was, it's hard to predict the end of the world. And of course, this is metaphoric. It's hard to attach a high probability to the end of the world. It's hard to know what to do if the world is going to end. Do you cash your money into gold? And if you do so, and you have to get a Coke, how do you pay for it? You take a penknife and carve off a little. And number 4, most of the time the world doesn't end. That was my analysis. Now, I wasn't taught that at Chicago, but that was the best I could do. And then I took kind of a gamesmanship approach, and I said, when you do gaming, you say, well, try this or try that, right? I said, if we invest today and the world melts down, it won't matter. But if we don't invest today and the world doesn't melt down, we didn't do our job. So that made this thing that was completely murky crystal clear to me. It didn't mean I was definitely right. But when you think about it that way, you can't reach an opposite conclusion, I don't think. We had raised an $11 billion fund for distressed debt investments at the beginning of that year. We said we're going to hold it as dry powder in case the shit hits the fan. And we barely started to invest it that summer. So we had invested like $1 billion of the $11 billion by the time Lehman goes under, and we just went hell for it. And from that fund, we invested $450 million a week on average for the next 15 weeks. That's $7 billion in one quarter, and that's all you had to do. But you see, you can analyze this glass of water. You can write a 10-page report on this glass of water. You can make 100 measurements of this glass of water. That was all you could know at that time. There was no other analysis that was possible. But common sense, I would call that common sense. It was not the Chicago theory. Mm-hmm. But what you have to have is you have to have a logical, firm thought process. And, investing, so that fund invested $450 a week for 15 weeks. The total of Oaktree invested $650 a week. That's $10 billion in a quarter. That's all you had to do.
Right. Since you brought up Chicago theory, I'll ask you, how do you sort of evaluate or rationalize the real world as opposed to the Chicago theory?
Well, this has always been a very important thing to me. I had the benefit of going to Wharton for my undergraduate degree in finance. And Wharton at the time, well, Chicago hadn't invented the theory yet, had it? So Wharton was entirely qualitative, pragmatic, and non-theoretical. Like, this is a stock certificate. This is the New York Stock Exchange. If you want to buy one of these, you go there. That was the level of inquiry at Wharton. So I go to Wharton and I get a nuts and bolts education in how to read a balance sheet and that kind of stuff. And then I come to Chicago, where everything is totally theoretical. There's no real world. Gene Fama in those days used to start every class by saying, "I've never spent a day in the real world, and I never will." But of course, he retreated from that, didn't he?
Yes, he did.
But to me, it was the perfect combination. The real world, pragmatic, and the theoretical, quantitative. But the challenge was how to put them together. And my favorite course was, there was a guy who taught an investment class named Jim Laurie. And Jim Laurie with, what's his name? Fisher. Laurie Fisher ran something called the Center for Research and Security Prices. Mm-hmm. Crisp, Merrill Lynch is funny, how times have changed. Merrill Lynch endowed this Center for Research and Security Prices. The job was, in 1962, to figure out what the return on the S&P had been historically. Can you imagine that was a research project? What has the return been? Well, try it without computers. So what they did is They got the Wall Street Journal every day from 1929 to 1962. They hired a bunch of students, and they had to copy out the prices every day for 33 years for the stocks in the S&P. And at the end, they concluded it was 9.2%. So Laurie teaches this class, and I loved it because unlike everybody else at Chicago, Laurie brought in real-world people interspersed with the discussion of the theory to talk about how they did it. And that was great for me, and it inspired me. And the final for his course, one question. It's the question you just asked. How do you reconcile what you learned about theory at Chicago with what you know about the real world? And I kept asking that question for the next 40 years at least. And I wrote a memo around 1998 called What's It All About Alpha? Thought that was a clever play on words. There's a movie called Alfie. It was Michael Caine. They did a remake. I forget who it was in the remake. But anyway, and Dionne Warwick, who's one of the great singers, sung a song, What's It All About Alfie? So I said, What's it all about Alpha? And it was a memo about how do you reconcile, in particular, the efficient market hypothesis with the real world. And I spent a lot of time in it. And it's what I learned at Chicago is to puzzle about these things. And these things that are hard to do, try to figure them out. And this has been extremely helpful to me. And I think puzzling about a question like that prepared me to answer the question about what to do on the Lehman meltdown. And so my answer for myself in this memo was that the efficient market hypothesis says that because everybody's trying so hard to find value and everybody's intelligent, computerized, numerate, highly incentivized, etc., objective and rational, prices converge with value. Everything sells for the price it should sell for. There are no bargains. There are no overpricings. And as a consequence, active management doesn't help because you can't find better or worse investments. They're all just fair. They're all offered at a fair risk-adjusted return. And that's my synthesis. I don't know if that's okay. That's my synthesis of the efficient market hypothesis. My answer is that the concerted efforts of all these investors cause people to incorporate information promptly to produce a price for every asset, but it doesn't have to be right. And because of the foibles of human nature, which I discussed earlier, motion and greed and fear and all those things, it's often wrong. But because of the human condition, it's very hard for any one person to improve upon those judgments. So there are often errors, but they're hard to find. That's my version of the efficient. The efficient market hypothesis, the prices are always right. I say they're often wrong, but it's hard to find the errors. And that's what I believe. And but there are more efficient and less efficient markets in the world. And so one of the ramifications for me is that we should only work in the less efficient markets where it's occasionally possible to find a bargain. I like to tell the story that the we used to tell the story when I was a student here, that the University of Chicago professor from the business school is walking through the campus with one of his students, and they're arguing about the validity of the efficient market hypothesis. So they walk along, and the student looks down. He says, "Look, professor, isn't that a $5 bill on the ground?" Professor says, "No, it can't be a $5 bill, because if it was a $5 bill, somebody would have picked it up by now," which is, of course, the essence of the efficient market hypothesis. So I teach a couple times a year at that other business school in Boston. And one day I was walking through the library. I got there early. I was walking through the library, and sitting on a display case was a $5 bill. So much for the efficient market hypothesis. Once in a while, there are fives lying around, and you can find them, but you have to get lucky.
Maybe I'll ask a couple of questions about sort of where do you think things are today? One of the things that's happening, you see it in the news, is just the rise of, quote, private credit.
Yeah.
What is that? And is that, I don't want to use the B word, but is it a bubble, if you will?
Well, businesses use borrowed money. If you have to engage in business, but you have to use all equity, most businesses are not profitable enough to produce a high enough return to reward your equity for the risk. So in order to make the capital more efficient, most businesses borrow some money. You borrow money at a fixed rate of return, which is lower than the desired return on equity. And that the fact that you pay a fixed low rate for some of your money levers up the return on your equity. In 60 years ago, good companies could borrow money by issuing bonds. Most companies could borrow at the banks. 1978, as I said, high yield bonds were popularized, and starting in 78, low quality companies could issue bonds, not just high quality companies. And Mike Milken's innovation was to say that low quality companies should be able to issue high yield bonds as long as they pay enough interest to compensate for the risk. And that makes total sense. And by the way, around 78, I think it was a sea change, and the world changed from saying it's fiduciarily proper to invest in high quality assets. It is improper to invest in low quality assets. We don't say that anymore. Now what we say is you can invest in risky assets as long as the price is the price, and thus the prospective return is appropriate to give a return which compensates for the risk. So now we do risk return thinking. We don't say good, bad. We say adequate, inadequate. So the first big innovation was the fact that low quality companies can now issue bonds publicly. Then we had bonds and banks. And when a bank like Citibank would make a loan to you, they would call three of their friends and they say, we made a $50 million loan, would you like to take 10 of it? And that was called syndication. And Manny Hanny would take 10, Chase would take 10, and B of A would take 10. Somebody had the idea in the 90s to create what are now called levered loans or senior loans. And so now an investment bank like Goldman says we're going to issue a loan to your company, and it's syndicated just like a normal security. So hundreds or thousands of people buy part of that loan, and it trades like a security. And I guess it probably is a security. Yes, it is. And the difference is that bonds have fixed rates of interest and loans have floating rates of interest. So now the loan market has started to do part of what the banks do. And rather than syndicate to 3 people, the loan is made by Goldman, they syndicate to hundreds of thousands through the sale process. The next big change comes, we have the global financial crisis. That meltdown process I described to you takes place. Some banks are out of business, other banks are chastened, and all the banks are regulated. And also they've lost a bunch of their capital, and so they don't have much lending power anymore. And so the banks kind of recede from the market of lending, and a couple of smart people on Wall Street says we'll take their place. So sometime around 2011, 2012, we get the birth of what's called private credit, and people like me start going to companies and say, we'll lend you money. Now, you can't get it from the banks. They're not really in the business. They don't want your business. So we'll lend it to you, but we need a high rate of interest, and we need secure docs. We need covenants and collateral and things like that. And so that's how it starts. And those people got the opportunity to make very safe loans with very high rates of interest. So that's what we call an excess rate of return, an excessive return, a superior risk-adjusted return. But everybody else sees what happens. The money flows in. Everybody competes to make the loan. I'm getting 11% from you, but then he says, I'll do it at 10, and she says she'll do it at 9. And over time, the loans become lower yielding, and he says, I don't need as much protection. She says, I'll do it without any protection. And now there are fewer or no covenants. So that's where we are to now. The private credit market has been quite commoditized. We might say maybe disintermediated, but it's very competitive, and it's no longer a free lunch.
So we got a bunch of questions in advance, and I'm going to go through some of them.
I apologize for the length of my answers, but there are no correct short answers.
One of the questions was about your co-founder, Bruce Karsh, who's a lawyer, and you also occasionally write about court cases. So the question is, what skills should young restructuring lawyers emphasize if they want to transition to distressed debt investing? And are there characteristics about lawyers that you value in your business?
Well, I think that if somebody goes to law school and succeeds, I think they learn how to think. And they also probably learn how to read the details. So, Bruce Karsh, Madhav mentions, one of my lucky days was he joined me in '87. He was a lawyer. He had worked at O'Mullen & Myers, which is one of LA's good firms. Then he got a job with Eli Broad, who was LA's biggest business and civic leader, as his special assistant, and worked on the bankruptcy of Johns Manville, which was a building materials company that had an asbestos problem. And they made a lot of money and it was bankrupt. And they made a lot of money in Mansville's debt. So he approaches me about the idea of starting a distressed debt fund. So, most people wouldn't buy distressed debt in those days. They said, just a minute, hold on. You're going to buy the debt of a company that's bankrupt. How can that possibly be okay? And again, if you're a contrarian, you say, well, if nobody else in the world will do it, then I will do it, and I'll probably get some bargains. And in fact, that's what bargains come from, is a buyer strike. So he did it with me, and he's a brilliant guy, and he was a good lawyer. What he says is that every lawyer wants to stop being a lawyer, which might be an exaggeration, but so far I haven't found too many exceptions. Obviously, if you want to work in distressed debt, you have to understand how the bankruptcy laws work, but that's kind of nuts and bolts. That's like if we want to be an investor, you have to understand accounting. That's, a necessary condition. But you have to know how to think, and you have to understand kind of the realpolitik. So the law says that if we follow the law, the settlement will be that you'll get X and you'll get Y and you'll get Z. But the law may not be followed because the process may be short-circuited. Rather than go through the whole legal process of bankruptcy, which could take 5 years, maybe everybody wants to settle it in 5 months, so they make a compromise. So, if you understand the realpolitik, you can do a superior job of predicting what the compromise will be. So you have to be able to do that. So the law, financial analysis, and I would say, the realities of negotiation, and tactician. You got to be a tactician because a lot of it is interpersonal workings.
We had a question about technology, which I think you probably anticipated. Like, where do you see technology changing, investment management, and how have you seen it change even at
Well, look, there have been many changes. Of course, the interesting thing is when I went to Chicago, one of the biggest change, I talked about the emergence of alternative investing. That was a big change. Another big change that took place, maybe the biggest, is that, when I went to Chicago, what the finance professors taught me is that the average investor does worse than the S&P before fees and much worse after fees. And what they said was, why don't they just buy one share of every stock in the S&P? There was no concept of an index fund. or of the process of indexation in those days. But that's what they did. And a guy named Jack Bogle invented the first commercial index fund at Vanguard in 1974. And you see, people, I mean, the concept of market efficiency is not absolutely correct, but it is far from irrelevant. And, you know, if you think that you're going to walk into the stock market and you're going to say, that one's overpriced, that one's overpriced, that one's overpriced, that's underpriced, and you think you're going to get it right and more right than anybody else, something wrong with you for the most part. Because everybody else is trying to do the same thing and they're not idiots. And everybody today has the same data. And so where does your advantage come from? And when I worked at Citibank, which was full of well-intentioned, non-Chicago people, non-Mensons, a client would say, well, how much money do you think you can make me in the stock market? They'd say 12%. Client would say, how do you get to 12%? So it was easy. On average, the stock market makes 10%. So anybody can go in and make 10% without any effort. With a little effort, I think we can do 20% better. Ergo, 12. Now, there's no reason to say that. That doesn't hold any water. It's not rational. Why should a little elbow grease produce 2% more return a year? And by the way, can it do it for everybody? Can everybody increase their returns from 10 to 12 by trying a lot harder? And how can the return in the aggregate stock market go from 10 to 12? Didn't make any sense. But, you know, I mean, take it from me 50, 60 years ago, there was not much deep thinking in the world like there is today. So the point is that all managed money, all equity money was managed actively, stock picking. Everybody charged high management fees. The average mutual fund had about 1.5% of fees and expenses. And so the stock pickers didn't add value. The S&P went up 10. The average stock picker, let's say they made 10. On average, the investors do average. But everybody charges 1.5%, so the clients get 8.5%. Something wrong with that. Shouldn't be, right? And it didn't be. And today, most mutual fund equity capital is managed passively and through indexation. So that's a big change.
So you mentioned you went to Wharton undergrad, and at Penn, Howard has been very instrumental in naming the writing program. And you're, of course, you write these fantastic memos. So the question was sort of, how do you come up with the ideas for your memos and come up with brilliant definitions? And that's what the question said.
Thank you. Any more adjectives?
Well, they give an example. They give an example, Howard. I'll give you that. Risk is uncertainty about which outcome will occur and about the possibility of loss when the unfavorable ones do.
Well, I mean, look, what I recommend is thinking deeply about things. Don't accept the definitions you're given. Don't accept the axioms you're think about it. Think about it right or wrong and see if you can figure it out better and describe it better. And so that's what I try to do. And, you know, I don't know if they're still showing the graph with it, which has a return on the vertical axis and risk on the horizontal. There's a line like this, capital market line. I didn't accept it. I drew my own, but it took me 45 years to reformulate that. But I'm interested in ideas, and so I would say just keep thinking about stuff and try to figure out stuff that other people haven't figured out. That's how you get satisfaction in this world. And then I like to write, and you know, I learned a lot about writing at Penn, and that's why I endowed the writing center there. And to me, it's a creative outlet, and I think it's very important that everybody not just be some kind of business grind wonk nerd, but also be multifaceted, have different aspects to your personality and your life, and have some non-business interests. And my creative interests are extremely important to me and a source of a great deal of my reward. And I don't think that just business success or just having a lot of money is everything.
So I'm going to open it up for questions from the audience. So if you have any questions.
And I have a book for the best question.
Okay. All right.
So let's make this competitive in the Chicago sense.
Let's do it. Any questions?
Nobody wants the free book. Here's a free
There you
book.
go. Go for it.
Okay. Here, wait a second.
Thanks for being here and speaking with us. What industries or technologies do you think are most exciting right now, especially for somebody who's entering business now, since a lot of investing is probably competed out? Is that still a place to be?
Well, I'm not, you have to know yourself and you have to understand yourself. And you're not going to necessarily be the person you wish you were. I am not a technologist. I'm not a futurist. I'm not a dreamer. I'm not even an optimist and about investing. So I am about life. So I'm the wrong person to ask about technology. And, Buffett and Munger have always said that you have to stick to your circle of competence. And, they would say, if you asked them about AI, they'd say, well, we put that on the too hard pile. And I do the same. I don't know anything about it. And the worst thing you can do is venture into an area where your knowledge is less than that of the others. But I mean, to me, the most exciting thing is figuring out what everybody else is doing wrong, and what everybody's psychology is, and what's wrong with it. And at this stage in life, I'm probably not going to learn a lot of new technologies, and I'm certainly not going to be like AI. I can understand what AI is, and I might be able to keep up with the developments, but I'll never have a superior understanding. And that's one thing you have to understand. If you have an average understanding of something, you're unlikely to be an above average investor in it. Above average investing has to come from a knowledge advantage. Either you have data that other people don't have. Oh, that's illegal. That's insider trading. Or you do a better job of interpreting the data than other people, or you do a better job of extracting the essence of the qualitative factors. Who's a better manager? What product is better? Who has a better product pipeline? Or you do a better job of figuring out the future. But you have to be better at something in order to have superior investment results in that field. I am not ever going to have a knowledge advantage in technology. So I put it on the too hard pile.
Thank you.
Oh, sorry. I'll try to give short answers.
Hi there. Thanks for coming. I'm just curious if you have any general advice that you would give to yourself as an MBA student if you go back in time and do it all over again.
Well, my general advice to all of you is very simple. My favorite quote on the subject of career is from a writer named Christopher Morley, who said, there's only one success: to be able to live your life your own way. And what that means is you should not take your instructions from society, social media, friends, parents. You got to figure out, what am I about? What's going to make me happy? And it's not easy. First, it requires introspection. And secondly, you're going to change over time. So it's hard to figure out at age 30 what's going to make you happy at age 50. But you have to try. And my general advice to make that a little more concrete is that I would suggest that you try to find something that plays to your strengths, avoids your weaknesses, and will make you happy. And I think it's very important to be happy. It's the most hackneyed thing in the world is the observation that on his deathbed, nobody ever said, I wish I went to the office more, or I wish I made more money. They say, I wish I had enjoyed life more. You only get one, as far as I know. Try to make the most of it and don't give up too much of your happiness just to have more money. Now, some people money may make them happy. A lot of people may think that money will make them happy. Some are wrong. But I would really argue against that. And by the way, when I was a kid, there was a thing, a comedian told a story about he was walking down the street and a thug jumped out of an alley and stuck a gun in his neck. He said, your money or your life? He said, take my life. I'm saving my money for my old age. Screwing up your life to make more money is exactly that. Why would you sacrifice the only life you're ever going to have so that you can die richer? That's my advice.
Question, somebody has a mic there?
Yeah.
Go for it.
Do you remember the first time you took a risk in your career, and what kind of gave you the confidence to take that risk and to...
The first risk in my career?
Yep. And what gave you the confidence to do that?
I mean, look, I was not somebody who designed his life. My life was a series of happenstance. Now, I made decisions that worked. Maybe I made good decisions that worked, or maybe I made bad decisions and got lucky. But I do not describe myself as somebody who engineered his career to a fare thee well. And but and by the way, so I didn't make the decision to leave the investment research department. I was kicked out in a very polite way. I didn't make the decision really to invest in high yield bonds. I was asked to do it, and I said yes. I guess. Well, you know what? The first big risk I took in my life, on my first business trip, which was January 1970, I went to California to do some research on some companies. I fell in love with California. And for a kid from Queens, New York, to see the Pacific Ocean and the palm trees and the convertible and the girls was pretty magic. And I wanted to live in California. And it was very hard because the finance community in California was infinitesimal. But finally, by 1980, I figured out a way to do it, and I went all by myself. I knew two people, and I didn't go with the partner, wife, and I went on my own. Took a shot. But, and I remember flying to California by myself, and as the plane came into California, I think this could be some big mistake. But if it's a mistake, I'll go back. But I don't want to get to be 65 or 70 years old and say, I wish I would have gone to California back in 1980. And I think that's very important. We have a director at Oaktree, and in his signature block on his emails, it says, better to try and fail than fail to try. And I think that's really important. So that was a big risk, but you have to realize, what the hell? Give it a shot. Or else, the worst thing that I think you can imagine, well, that might be exaggeration, but what a terrible thing it would be to get to be 70 and say, I wish I had XYZ. Give it a shot. If you're resourceful, smart, resilient, etc., try it. I guess what I'm saying is one really strong piece of advice is don't be afraid to make a mistake. Mistakes are not the end of the world.
Who's got the mic?
Yeah, on way back here in the back. Mr. Marks, thank you for being here. It's awesome to have you back. You talked about a lot of the calls that you got right. Are there any calls you look back on as ones that you think, man, I really got that one wrong? And what did you learn from that?
Well, I don't think I made any significant market calls that were incorrect. And I wrote did I tell you I wrote this memo? I've spoken to so many people today. I wrote a memo called Taking the Temperature, which describes how I made the 5 calls so you can assess them. But, we made mistakes. We stuck to credit. We could have gone into the private equity business, which became, a really big thing, I would say, from 2005 to 2020. And we basically didn't do it. So, I would say that we didn't make too many errors of commission, we made some errors of omission. But, I have a conservative personality. So I'm more likely to make errors of omission because of not having tried things.
Thank you for taking the time to speak with us. So looking forward, what is the thing you're most excited about in the markets moving, for the next 5-10 years?
Oh, you know what? I just want to keep doing the same thing. And if I can continue to assess the current environment in a superior manner and share that knowledge with my clients and my colleagues and get recognition for it, that's all the reward I need. I go to work every day, or almost every day now. I'm almost 79, and I don't get paid to work. I don't get a salary. I don't get a bonus. I don't get profits, interest in our funds. It beats the crap out of golf, as far as I'm concerned. And it's an intellectual. You get the greatest satisfaction in life, depending on the area, is to accept the challenge and master it. And I get to do that every day, and I don't need any new ones.
We have time for maybe one or two more questions. Yeah, go ahead.
Let's say two.
Two.
Thank you for being here. So you talked about building a circle of competence. How did you find yours, and how did you build it, and how would you suggest that we go about doing the same thing?
There's nothing magical about it. You try stuff. If first of all, what you want to find is the intersection of the things you're good at with the things you like to do. It would be terrible to spend your life doing something that you're good at that you don't like, or something that you like but you're not good at. So try to find the two and try different things, and it'll be perfectly clear quickly what you like and what you're good at. And we can't know too much without trying. Just try to get a diversity of experiences.
Last question. Go for it.
Yeah, I'm curious what you see as the future of distressed debt investing. Yeah, do you think people are going to keep coming up with all these kind of crazy strategies like J. Crew or like double dip financing and all these sorts of creditor on creditor balance strategies, or is there going to be some tipping point where it calms back down?
Well, look, for some bizarre reason, a lot of the smartest people in our society become investors. And so there's all this IQ and all these wiles released onto Wall Street every year. And everybody tries to find an edge and a wrinkle and a way to make more money than the other person. And the rate of innovation on Wall Street is extremely high. And people can get money for innovative products on Wall Street because everybody wants to get rich. And they'll give them money. And so the level of innovation is incredibly rapid. And, each of our funds does things that the previous fund didn't do. We have to keep innovating to stay up with it. And, what you mentioned about creditor on creditor violence, people try to make money that other people don't make, and some of them try diverse tactics to do it, some of which, I guess as long as they're reasonable, it's okay. Hopefully legal and hopefully ethical. But people try stuff all the time. And that's one of the interesting things about the investment business is that yesterday's solutions won't work tomorrow. And, there's an interesting book called Fooled by Randomness by Nassim Nicholas Taleb. And he compares investing, which is beset by randomness, in which anything can happen on any given day, and you can't tell who's really a good investor because you don't know who was lucky or not. And he compares it with dentistry, in which there's no randomness. And he says, if you want to be right every time, become a dentist. And if you go to dental school, you learn how to fill a cavity. You fill a cavity that way every time, you'll have a 100% success ratio. Not that interesting. Only become an investor if you're happy with the batting averages of about 60. 65 would be great. You have to live with a lot of failures, but interesting, changing, evolving, stimulating, challenging, and there are always new things. So thank you all for letting me come and speak to you today. Chicago was great for me, and I'm sure it will be for you.
Thank you. Thanks so much.
Keep your minds open.
Thank you.